It's time for Mike on the Money. The United States is about to max out its borrowing capacity in the coming hours. So what does that mean for your money? Mike Giordano, financial advisor with Williams Wealth Management, is here to help us sort this out. First of all, Mike, what is going to happen in the next couple of hours exactly?
Yeah, so the debt ceiling, it's kind of like credit card credit limits, right? We all have them. The credit card says you can spend $20,000, $30,000, $40,000. And once you hit that max, they say we're not giving you any more money unless you ask them to raise it. And so that's exactly what the federal government's saying. We got $31 trillion, but we need to spend a little bit more than that. So they want the debt ceiling raised. And according to the Treasury Department, tomorrow they'll max out on all of that credit.
When is the real deadline for doing something about this? Has it passed?
No, it hasn't. That's the fascinating thing. I mean, like, tomorrow's the actual deadline, but the real deadline, the Treasury Department can go into extraordinary measures, and they can basically keep funding things through, they estimate, the beginning of June. But that all comes down to how much money they collect in tax receipts this spring. So there's a couple of months to try and negotiate things, but there's a little wishy-washiness on when the exact date is.
What's the feeling? Can this be fixed?
Yeah, I mean, at the end of the day, I mean, they've raised the debt limit, the debt ceiling over 100 times since World War II. So politicians, they love to, play their brinksmanship games. But at the end of the day, nobody wants to be responsible for a default of the U.S. Debt. And so they will come to a deal. It's just a matter of when.
What does this all mean for us on a day-to-day basis?
Well, just like if you were not to pay your own your debts off, it's going to really cause a lot of hardships in terms of how much it costs you to borrow in the future. Mm-hmm. Same thing for the federal government. I mean, if we were to actually default on our debt for the first time ever, you could cause a recession, interest rates would go higher, we'd have a weaker dollar, a whole bunch of bad things. Hard to see anything that would be actually a positive.
You're trying to be a good, proactive investor. What does this mean in terms of that?
Yeah, so in terms of how badly it could be for investors, it's not good. If we were to default and like all those things happened, a recession, weaker dollar, higher interest rates, all those things are bad for the markets. We got close there in 2011 when we had a credit downgrade and the markets fell 6-7%. If that would have persisted, the markets would have kept falling. Mm-hmm. But fortunately, cooler heads prevailed. But at the end of the day, they're going to come to a deal on this thing. The bigger issues for the markets are still what the Fed does, how inflation comes in, all those kinds of things.
Mike Giordano, thanks for helping us sort it all out.
Absolutely. I'm going to go max out my credit card now. I'm just kidding.
We'll be right back.